Welcome to UK Matters in Accounting on behalf of the Accounting Influencers Podcast Network, show coming out every Friday, predominantly to accounting practitioners and the fintech professionals that surround them here in the United Kingdom, because this is where the world began and this is where it all happens in accounting and fintech, or so we think. Thrilled to have with me today a true UK influencer in the accounting space, Will Farnell, author of The Digital Firm. Good day, sir.
Hi, Rob. Nice to be back with you again.
Will, one of the topics you have your finger on in the UK is the mergers and acquisition space, the consolidation, the movement, who's buying, who's selling, who's doing what. There's a lot of interesting things going on. We're going to talk about that today. Just give us an overview of what all this means.
It's a really interesting time, Rob, and I've been following this now for the best part of 3 or 4 years, and it started because I had this kind of view that the money men and women, the private equity firms, the VC firms, were making sizable investments in the technology that, as accounting businesses, we rely on really heavily. And my personal view of this was that, well, they're spending all this money acquiring all of the technology that we use. I think there's going to become a point where they say, you know, we've got the technology, so now why don't we buy some of the service delivery end of this process? So for me, that was quite appealing because I was building a high growth accounting firm. And like any good business owner, we always have an eye on the exit. For me, it was a case of, well, this presents an opportunity, because if I think this is what's going to happen, then how do we get best placed? So when it does, and these private equity people start to look at accounting firms as an opportunity, because we have really good quality earnings in an accounting business. It's a thing called gross recurring fees, and basically, as long as we don't mess up, our clients keep coming back and paying us year on year. So quality of earnings is really high. If you're a high growth accounting firm, and that's really only kind of 20%, you become an interesting proposition for people that are looking for good quality earnings on a recurring basis. So it kind of looked like there was an opportunity to be had. So I started following space, and interestingly, a couple of years ago, 2-3 years ago, we started to get the phone calls, and we started to get the LinkedIn approaches from private equity saying, hey, look, we're looking at the accounting space and we think there's opportunities here, and would you be open to a conversation? And on the back of that, I've kind of followed the developments, and my own view is we have probably about 11 or 12 consolidators in the UK market at the moment, majority of which are private equity backed. It creates lots of interesting opportunities and challenges. And the reason I think we can look back and see failed consolidators of years gone by. And the big challenge, I think, is that so much of the accountancy profession is made up of partnership models, where there's multiple partners with multiple views of the way they want to do things. So it isn't conducive to the corporate world of private equity. However, the number of players in the market at the moment, we did some kind of rough back of the fag packet calculations, and came to the conclusion that the amount of money that's circulating at the moment could buy about number 15 to number 100 in the top 100 accountancy firms in the UK. That's completely unsustainable. So some of the people that are in the market looking at consolidation at the moment might leave disappointed. But it's a really interesting space.
And when you say there are opportunities as well as challenges, are those opportunities for the consolidators or the firms that they are acquiring? Or
both, because we know that we have a generational shift going on, millennial, Gen Z, who have very different attitudes. Home ownership is more expensive than it's ever been. So when you get a trade-off of, do I buy into an accounting business or do I buy a home, succession is much more challenging perhaps now than it was 20 years ago. So firms are having to look at what are the options for us. Those partners that are locked in, have got capital locked up in partnership models. How do they exit? How do they benefit from those years of investment into growing those practices?
And a younger person coming into accounting firm is perhaps not enamored with a business model that forces them to pay capital in to pay off partners at the top end. So you need a new business model.
Absolutely. The future of the partnership model is probably a conversation for another day, but absolutely, you're absolutely right in terms of, particularly if the business isn't being run in a way that they think it should. And we've got that whole kind of technology shift that's going on at the moment that means that so many times that kind of top talent is saying, well, you know what, I can probably do this better on my own. And they're spinning off and doing their own thing and building their own practices at really high growth rates.
And when you talk about the challenges, we've got the opportunities on both sides of the table. The challenges presumably also are on both sides of the table. You talked about some unsustainability in the way firms are run. We've heard of private equity and acquisitions going wrong. So talk to us a bit more about those challenges on both sides. What can go wrong?
So I think for the firm, it is a big change as soon as you become a part of a corporate investment. A number of things changes. You're not controlling your own destiny in the way you might have done. Many of the deals that are being done need kind of remuneration caps and things to enable it to be profit, to plow into new acquisitions and so on. So there's a big change in terms of the internal operation of the businesses. Equally, it's a case of what's best for the client. We've got to remember the client in this. What are the opportunities for that small minority that actually still aspired to buy into a partnership? Because we've just said on one hand, less want to do it, but there's still some that are going to have their sights on that and saying, well, actually, I want to be a partner. And if it's a corporate model, then that kind of almost eliminates the opportunities for people to buy in once there's corporate ownership. What we haven't seen yet is what the cycles look like. So most private equity firms work on 5-year cycles. So what happens in 5 years' time when they want to roll the investment? So there's lots of unknowns, but what we're seeing at the moment is the sheer number of people that are jumping on the bandwagon that is creating this unsustainability in terms of there just aren't enough acquisitions to go around. And then it's a case of, well, everybody's looking at the same. There's only so many firms north of 2 million revenue in the UK. And that's where the private equity guys are tending to look, because they've got to be big enough deals that they can build it. And what they're trying to do is build critical mass. So they go from being a kind of an accountancy business into an accountancy platform where the EBITDA multiples jump from kind of 6 to 10, 12, 14 times.
Might we see some kind of price war, Will, if there's only enough firms to acquire, but an increasing number of consolidators? If two are looking at the same firm, almost like a soccer player in the top leagues, well, I'll pay 20 million for him. Okay, well, I'll pay 25 million for him. And there's a bit of a bun fight.
Absolutely. And that's kind of inevitable. We're starting to see it already. I think that it is going to drive up pricing. The challenge, of course, is that as a profession, we've got really hung up on this kind of revenue multipliers. So you ask most people, what's your firm worth? They'll say, about 1 times revenue. And what has been a problem over a number of years is that's what everybody gets told. So everybody gets told, your firm's worth 1 times revenue. But is it really worth 1 times revenue if you're not making any profit? And actually, we looked at some acquisition within our firm, and we looked at in the region of about 65 firms in a 12-month period. Now, arguably, these are smaller firms. Our profile was kind of 750,000 to 1.5 million revenue. But the vast majority of those firms, once you started to add back owners' salaries and so on, replacing those people, they really weren't making any money. So all of a sudden, you can't expect 1 times revenue for your business if when you kind of replace you with somebody else to do the work that you're doing as the business owner, that you're then not making any profit, because you're not going to sell your business for 1 time revenue if you're not really making a profit. So really interesting that, and it was a stat that QuickBooks shared on their roadshows back in 2019, where they put up a stat that I didn't believe at the time. And they said 50% of accounting firms are not making any money. Wow. And I couldn't believe it. But actually, our own research and evidence based on what we were looking at suggests that at least half the firms we looked at weren't making any money.
Which is not making any profit specifically.
Yeah, which is astonishing.
So, Will, just to finish this off, let's get out your crystal ball. We know how notoriously difficult it is to predict what's coming up now over the next 90 days, let alone the next 90 years. But where are we going to end up with this journey that we're on with M&A activity?
Certainly, there is going to be more consolidation. There's no doubt about that. Consolidation is going to be happening at the mid-tier level, which means it creates opportunities for the larger, smaller firms that are just below that kind of mid-tier, because as more mid-tiers get swallowed up, there will be clients out there, there will be employees out there that say, you know what, I want to work for a smaller firm. The firm I was with was okay, but now it's part of this big group. So there's opportunities for everybody here. There's also opportunities to kind of get a key message across to clients that you're excuse a cliche, you're kind of small enough to care but big enough to cope type messaging. So there's opportunities right across the board for everybody here, but certainly we're going to see more consolidation. We will certainly see some of the consolidators not delivering what they think they're going to deliver because there's just too many. The fact that we've got a dozen or so trying to consolidate when we go back to the 90s, and we saw two that couldn't make it work, at least two that couldn't make it work. So it's a really interesting space. It's great that the private equity world sees the possibilities and the opportunities within our market. It's a hugely fragmented market, lots of opportunities, but it also means there's opportunities for small firms to do some of their own consolidation and use organic or use acquisition as an alternative to much longer term organic growth.
Yeah, we talked a lot about acquisitions, but not mergers. There was a recent big top 20 merger in the UK with BKD and GHD to form Forvis, which is now a top 10 multi-billion pound firm. So the consolidators could consolidate and buy one another, and we get bigger movement in the top 10, top 20. Is that possible?
Oh, absolutely. And I think most of the private equity deals are likely to be focused on building a critical mass and then selling it to a bigger group. So you get a consolidation into a consolidation. So I'm sure that's, if you look at it, you look at the scale. I mean, Assets is on the open market now for somewhere in the region of 1.5 billion pounds. So clearly it's going to be another financial institution that has to buy that, because it's not going to be another accounting firm, but at a much smaller scale, where you've got 30, 40, 50 million pound accounting businesses that could be subsumed into another private equity backed platform. So really interesting times. We don't know, Rob, what it's going to look like in 5 years' time, but it's certainly going to look different to what it does today.
And I just wonder, Will, in closing, whether the fintechs will buy an accounting firm. We know the market cap of companies like Iris and Wolters Kluwer and Intuit and Sage and these others, they've got plenty of deep pockets and PE backing. They might just buy a big accounting consolidator and work on both sides of the fence.
Yeah, it's always an interesting one, and I've had conversations with a few of them on that over the years. And I think the standard argument is, well, we couldn't be seen to be competing with our customers. Right. So I think that's probably the thing that might stop that happening. But we know already that HG Capital, who own a significant amount of accounting tech, also owns Assets and various other accounting entities already. So it's kind of happening. Just not quite as open as you positioned it a moment ago.
It's a fascinating chat. Thanks so much, Will Farnell, for giving us a wonderful overview of the mergers and acquisitions, the consolidation space here on the UK Matters in Accounting podcast.